Getting a mortgage in the US is expensive. The average rate on a 30-year fix today is hovering around 7%. In 2021, interest rates were around 2.75%, which is a $1,285 difference in the monthly payment on a $500,000 mortgage. This equates to a 63% increase in just 3 short years. Right now, not only do we have high interest rates, but we also have high prices, even with the Fed cutting 3 different times already. So the question is, why aren't the Fed rate cuts making mortgages any less expensive? Interest rates are determined by many factors, including decisions made by the Federal Reserve. And while the Fed is cutting rates, it's not making it any easier to buy a home. So why are mortgages expensive even as the Fed tries to ease economic conditions? I think it's important to start videos like this by explaining what the Fed's job actually is and why they actually have something called the federal funds rate. The job of the Fed is a dual mandate. One is price stability. The second is maximizing employment. Now you might be asking, well, what is price stability? The Fed has a goal of inflation hovering around 2% on an annual basis. So anytime inflation gets above that 2%, not only does that mean higher prices, but it also means a stronger economy. And typically what happens when you have a stronger economy is you have prices continuing to increase year over year. Exactly what we saw during the pandemic. Now, part of that was all of this money just thrown at people who were locked in their homes. They couldn't spend money at the time, so they were just putting money in the bank. In addition to that, you had businesses locked down and they couldn't create products, which put a damper on supply. So now when we come out of the pandemic, you have people that have all this money saved up. They're now able to go out into the economy and spend it. And because businesses weren't able to create certain products during that period of time, you have more buyer demand than you have the products out there that people want to buy, which in turn drives the prices of those products up. And because of this, we saw inflation peak at 9.1%, which is 7% higher than the Fed's actual target. In addition to that, you had businesses thriving out there because consumers were spending a lot of money. And because of this, businesses needed to hire employees. And because of that, we saw employment down at record lows. So when we think about the Fed and their dual mandate, what they don't want to see is prices continuing to climb year over year. And they ultimately don't want to see unemployment really moving higher either. They really want this Goldilocks scenario where both prices and employment are stable. So you're probably watching this going, okay, well, how do they accomplish that? Well, that's where the federal funds rate comes in, not to be confused with mortgage rates. The federal funds rate is an overnight rate in which banks lend money to one another. And the lower that federal funds rate is, the cheaper it is for banks and businesses to borrow money. And the cheaper these businesses are able to borrow money, the cheaper they're able to lend it out to the consumer in products, in loans, in turn allowing their businesses to grow. And because the federal funds rate was at 0 during the middle of the pandemic, a lot of these businesses, these banks were lending and borrowing money at very, very cheap rates, which not only boosted their business, but it also boosted the economy. And that's one of the things that sent inflation higher. And that's something that the Fed doesn't really want to see. And that's why they hiked the federal funds rate as much as they did, taking it from 0% to 5.5% in just 2 years. And this had a couple of different effects on the market. One is it slowed businesses down because now they're not able to borrow money quite as cheaply. But it also had an effect on the housing market as it moved interest rates higher. And the primary reason for this is because the Fed was trying to fight inflation and bring that stability back to the market. But some of the unintended consequences of that is something called the lock-in effect, which is where homeowners with ultra low interest rates have now been essentially locked into their homes, unwilling to sell, which in turn reduces overall housing inventory. So now you have an inventory shortage, which is part of the reason that we saw home prices go up so much during the pandemic, coupled with affordability issues because now we have higher rates and higher prices, which is not only hurting homeowners, but it's hurting the ability for first-time home buyers to go out and buy a home. So why aren't the Fed rates cut actually helping interest rates drop? And that's because the federal funds rate doesn't actually control mortgage rates. Mortgage rates are actually determined by something called mortgage-backed securities, which closely follow the 10-year Treasury note as more of a benchmark for mortgage rates. And at the time we're filming this video, the 10-year Treasury is sitting somewhere around 4.55%, which is about 2.45% less than where 30-year fixed rates sit today. So why the discrepancy in the two? Well, there's actually something called a mortgage spread that's added onto the 10-year Treasury note that gives you a better idea of where interest rates are actually going to trade. The mortgage spread essentially represents the lender's profit on that loan. It not only encompasses the cost associated with originating that loan, but also the cost to service that loan. And when we look back historically, that mortgage spread is somewhere around 1.75%, whereas today it's just over 2.4%, which means in a more traditional market, if the mortgage spreads were normal, interest rates today would be sitting around 6.25%. But rather they're sitting at 7%. And the main reason behind that is because that mortgage spread has widened. It went from 1.7 to 2.4. And part of that is because of those servicing rights that I mentioned earlier. Lenders don't want to necessarily make loans at those lower rates because there's this belief out there that interest rates are going to continue to trend down. And what they don't want to do is put a lot of loans on their books at higher interest rates because they know that those people are likely to refinance. So if they refinance, then they're going to end up losing money on those loans. But here's something really, really important to note. As mortgage rates continue to come down, which they will in the future, those mortgage spreads are likely to improve. While interest rates might not be moving down as quickly as you would like to see them, now is a good time to focus on the things that are going to impact that mortgage rates. Things like your credit score, things like your down payment. Focusing on the things you can control while you wait is one of the best ways to take advantage of lower mortgage rates when they're available. My team and I have helped a lot of people here on YouTube not only buy homes, but refinance into lower rates. So if you're someone sitting on the sidelines wondering if you can buy in 2025 or if you'll be able to refinance in 25, reach out to my team directly using that link below. So going back to my question a moment ago, why hasn't the Fed's rate cuts helped mortgage rates drop? And the primary reason for that is because the federal funds rate affects more of the short end of the yield curve. It affects shorter term rates. Most loans are 30-year fixed rates, so the longer end of the yield curve doesn't get impacted initially by these Fed rate cuts. It takes time for it to work itself through the market. On top of that, the Fed has been very, very transparent in what they plan to do. They have a plan, they have meetings, they have minutes that are released that go out to the public. And so the public has an idea of what the Fed is thinking more or less at all times. And because of that, the market typically knows ahead of the actual meeting whether or not the Fed is going to cut rates. So more often than not, it's already built into the market, which is often reflected in the 10-year Treasury because the bond market usually gets ahead of the Fed. In fact, that's exactly what we saw in September before the Fed cut 50 basis points. We had already seen interest rates move to yearly lows. And as the Fed made their announcement of a 50 basis point cut, mortgage rates actually went the other direction, which is the concept in financial economics where asset prices reflect all available information. So the market already had all the available information coming up to that meeting. So they already knew the Fed was going to cut, which when the market delivered on that news, there wasn't really a positive reaction to that information because it was already built in. So you might be asking, well, why did rates shoot up from that point? Well, it has a lot to do with the unknowns of the market. Where is inflation headed? What's going to happen with Trump's policies? How are all of these things going to affect the overall market? And because the Fed is cautious and they don't want to get too far ahead, they've essentially come out and said, well, we're kind of waiting. We're going to sit back and wait to see what happens in the market before we do any additional rate cuts. And the market doesn't like that, because previously the Fed had come out and said that they had planned to cut 3 to 4 times in 2025. Now they're saying they may only cut 1 time. And this is creating volatility in the market because this is different from what the Fed has initially said. So you're probably asking yourself after watching this, well, what does that actually mean for mortgage rates? Well, it probably means much of what we saw in 2024. Interest rates improving as the economic outlook worsens. Yeah, that's right. As the economy gets worse, interest rates typically get better. And on the flip side, if the economy continues to outperform, we see low unemployment numbers, we see higher inflation as if businesses are continuing to thrive, then that likely means not only is the federal funds rate going to stay higher, but mortgage rates are going to stay higher as well. So while the Fed's rate cuts might not be working exactly as how you expected, understanding the forces that drive mortgage rates can help you navigate today's tough market. Remember, knowledge is power, especially when it comes to your biggest investment.